Josh, there's going to be a massive crash in UK house prices. Why on earth are you still buying? So hi everyone, hope you're doing really well. Welcome to this video where we're going to reveal 5 reasons that Beck and I are both still doing buy-to-lets and flip properties even with this financial economic uncertainty. Now after we get over this hurdle of, well, what do you mean by a crash exactly? And we have that conversation, which is quite interesting. And by the way, if you have any of your own opinions on what a crash actually is, then please share those in the comments below. I'll be very interested to hear your opinion. But what we do is then say, well, look, let's go back a little bit in time and go back to 2008, the big financial crash of 2008. If you look at the ONS data, the ONS tells us that there was basically a 13% reduction in UK house prices. But that's taken as a whole. If you look at the data in a little bit more detail and you look at different areas and different house types, you realise that actually the range of falls were completely dependent upon areas and house types. Some didn't really fall at all, but some fell as much as 20% and some fell as little as 5%. So let's just put that into some sort of like pictorial model for us. Think of a £400,000 house that loses 20% of its value. It's lost £80,000 and now it's worth £320,000. But you see, a £100,000 house can't suddenly lose £80,000 and be worth only £20,000. It just doesn't happen. But a £100,000 house could lose 5% of its value and be worth £95,000. So why? Why is that possible, that a more expensive house can lose more money than a cheaper house? Why? And this is all based upon the fundamental principle, and I've done an episode on this before, that most UK house purchases are done so with a mortgage. So when mortgage interest rates rise, people can borrow less. And of course, if people can borrow less, they can only look at cheaper houses. So what we find is people that were looking at the £400,000 price bracket are now having to look cheaper into the £300,000 price bracket, hence in the £320,000 mark. And that's of course true for the next bracket. People that were once looking at the £300,000 house are now having to look at the £200,000 bracket for houses. And the people looking for the £200,000 houses are going to have to consider the £100,000 or £150,000 price bracket. So what we find is there are less people that can afford a more expensive house. This is what this crescendo, as we call it in music, is trying to depict. Less people here, but more people at the cheaper end. So what we find is this principle. As interest rates rise, there is greater upward pressure on the cheaper house. That picture is trying to depict that type of house. There's a compression as people are forced to look cheaper. There's a greater weighting then to this type of house, which means because there's more competition, then it keeps upward pressure on the house price and it doesn't fall as much. More people can buy a house for £95,000. And of course, this principle underpins our flip strategy. And think about this, you see, when in 6 months' time our refurb is finished, there's perhaps going to be more people looking at that house in 6 months' time than there were 2 months ago, a month ago when we actually had the property sale agreed. Because 2 months ago, people were still looking perhaps at the £200,000 house price done up. But now, once this economic effect comes through in 6 months' time, you're probably going to have more people looking at this sort of house. Then I'm not going to say that this house, we think it's worth £125,000 done up. I don't think it's only going to come worth £150,000, but I just don't think it's going to lose a lot of money. I think it's going to keep the price where it is and perhaps even increase a little bit. Which then introduces us to this next idea, these pauses, I call them. Because I know that there are people currently who are waiting to see what's going to happen in the new year in terms of interest rates. There are people waiting, stepping out of the market to be spectators to observe. So what does this mean for our flip project? Well, if there are flippers in our area who are now waiting and not buying now, then of course it means that in 6 months' time, they're not going to have their products to bring to market when there's this increase in demand for done-up houses. So actually these pauses help us. This uncertainty in the market where people are frozen or paranoid to get involved, we see this uncertainty as a great opportunity, hence our plan to get in and keep doing it. So these pauses mean there's going to be reduced competition, less houses done up in 6 months' time, but there can be more people to buy it. So it's good, we think, from a flip point of view. And just a second point about this idea of pauses, I have known since I started becoming aware of property 2016, 2017, and I was still in school, I heard people saying, I'm going to get into property, I'm going to do a buy-to-let, I'm just going to wait until Brexit's finished. And then I heard people say, well, I'm just going to wait to see what's going to happen after COVID because I'm sure there's going to be a house pricing crash. And now I'm hearing people saying, I'm just going to wait and see what happens after this economic turmoil because I think it's going to be a house pricing crash. So there have been people that are waiting and waiting and waiting and waiting, where we have been got in and we've purchased, and we have had hundreds of thousands of increase in value already. We've got ongoing cash flow that's paying for our way of life. We've got millions potentially of capital appreciation in the next 30 years and ongoing rental income. So the pauses, I really do think, are missing out. Now, so what about buy-to-let? That's good for flips. What about our buy-to-lets? Well, the first tick is related to the first tip of the flip. The same principle, we buy a house that's relatively cheap, in this case £57,000, we do a refurbishment and we think the house is going to be worth 110 done up approximately. Of course, if there is this greater demand for cheaper end houses, then in that little locality, within quarter of a mile or half a mile of that house done up, other houses might be worth being sold for perhaps 115 or 120. So it's good for our gross development value if there's upward pressure on that sort of price point of house. Again, it might not actually go up, but I just don't think it will fall much. What's the second tick for? Well, the second tick is for the rental, because again, for the same reason, interest rates increase means people have less disposable money to spend. And if we apply this same idea, but to now a rental, people who are once renting a house for £1,000 per calendar month, when their contract runs out or in a few months' time, they are perhaps going to have to consider renting a house for £900 per calendar month. And people who are renting for £900 per calendar month are perhaps having to consider £800 per calendar month. And people who are perhaps renting for £800 per calendar month are perhaps having to consider £700 per calendar month. And where do we operate? We operate between £650 and £800. So we're in that lower end of the market that gets affected less. So again, the same crescendo, this was for buyers, it applies to renters as well. Less people can afford the more expensive rental properties. It puts upward pressure, which means rents just can't fall as much because there's the same supply-demand issue. So for buy-to-let, it's good for both reasons. The fundamental economics in terms of supply and demand for purchases, but also for rentals. So that's our plan. That's why we are still buying, even if there is this pending crash and house prices are going to fall. Thank you for watching. If you've got any thoughts or questions or want clarification, of course, just share those all in the comments. We'll get back to you. We appreciate you watching this. Thank you so much for supporting the channel. We'll look forward to seeing you in the next one.